What's going on, everybody? Michael T. Ragland here. And on this video, I just want to jump in, and first we're going to address the market crash, and then we're going to jump into some sectors to actually invest into in this sector rotation, because all signs are pointing to an interest rate cut. But we'll see what Uncle Jerome Powell says here in a couple hours at Jackson Hole. But before we get into that, I've just been sitting back watching the market and looking at how people reacted to this crash, if you will, when prices corrected back to more sensible valuations based on the yen carry trade. Japanese government has historically kept interest rates super low. We're talking about like negative, below zero for a super long time. That's just part of their economic policy. So what investors were doing were basically borrowing money from Japan at rock bottom rates and then using it to buy your huge runners like Nvidia and other stocks around the world, invest in businesses, whatever, right? That's a carry trade. And then they were just pocketing the difference between the rate and they're paying those loans back. And it was an easy trade for 30 some odd years. Well, finally, the Bank of Japan decided to actually raise those interest rates after keeping them at zero or negative for so long, and that caused a lot of shock in the marketplace. Then on top of that, we also had companies that were just super overvalued. One thing that was happening in the AI or tech space is that companies were spending a lot of CapEx, aka capital expenditures, which means they're investing a ton of money. And in business, when you invest money, you want to start to see revenue coming in. And then you got to find a way to extract profit from that. But long story short, with AI, the only companies that were really crushing it was your Nvidias and your TSMs and your infrastructure plays and chip companies, right? Because they were on the supply side of these companies. But the actual companies themselves, your Googles, Apples, and well, I wouldn't say Apple, because Apple has actually found a way to do it without spending a lot of money, which is the topic of another video. But your Googles and definitely your Microsoft and some of the other bigger companies are spending a lot of money in CapEx, Amazon included, and not seeing that return yet. But it's an okay long-term play because they feel like that revenue will come in, but that does weigh on the stock and how shareholders view it, because they're like, am I getting a good return on my investment when we're going to start to see returns from all this capital investments into AI? And people started to see that. I mean, you look at the valuations, you can only break all-time highs so many times before the market pulls back. So it's a perfect confluence of factors that actually cause that market correction. Like, I know I could have made a video that said, oh my God, the stock market crashed, and that would have got a lot of eyeballs, but that would have been just clickbait. So that's what's happened with the market. I just wanted to address that before I got into it, because one thing that we started to see in the last Fed meeting, all signs are pointing to a at least 25 basis points or 0.25% interest rate cut. And that's going to change a whole lot of things. And it's funny, right? We're in a very interesting environment because normally tech and consumer discretionary, which kind of electronics falls into, doesn't do that great in high interest rate times like we've been in for the past couple of years. But due to the AI boom and the investment in it, and every company in their earnings call saying, AI, we're going to do something with AI, it's really kept those valuations up. And we've had Nvidia and all your semiconductor infrastructure really keeping that market in the S&P 500 sky high. But what we're actually going to see is something more traditional now. If we actually pivot to a, I wouldn't say low interest rate, because they don't want to go too low because then they're going to cause inflation to push back up again. But with some of the economic data that has been coming out, all signs are pointing to those cuts starting to slowly tease out, hopefully starting next month. I don't know. We've been promised 6 cuts this year and haven't got nothing yet. So usually in the market, when you're an investor, you don't want to be sitting here months from now when everybody is like, oh, invest in consumer discretionary and home builders and all these other companies that actually do well in the low interest rate environment. You want to start rotating your portfolio right now. Like, my favorite term is I stay ready so I don't have to get ready. So let's actually dive into some stocks that actually do well in a lower interest rate environment. So first things first, real estate. Right? There's so many people that are like, oh my God, I can't afford a house. I'm gonna be renting forever. Times are super hard. And it's true, right? Because with inflation and just the demand being so high on houses, that those prices have stayed right up there and it's harder to get into the market. So what's gonna happen as soon as people see these interest rates start to drop, they're going to be ready to jump in and invest back in the real estate market. So you can look at real estate investment trusts like Vanguard, V&Q, which I'm using that as a strategy, right? Like, I'm not investing in individual real estate companies yet, but I'll talk about the one I do have my radar when I start rotating. I'm just using V&Q, which is the real estate investment trust for Vanguard, which is one of my favorite actual funds with low fees. All about their ETFs, right? VOO tracks S&P 500. Everybody that talks to me about getting started investing, I'm like, just put some money in VOO, leave it alone, so you can understand how the market works. Because if VOO or the S&P 500 fails, then we're all in trouble. But like I said before, real estate is definitely going to see a turn, but not just thinking about it as a consumer or somebody who wants to buy a house and you're ready to jump in and sign up for a loan because there's lower rates. Think of it as an investor, right? Well, who in the real estate company is struggling right now? So I look at DR Horton, or DHI for the ticker symbol, and those guys have a solid balance sheet, like a super strong company, but they've been pulled down by these higher interest rates because, of course, demand's going to be lower for home builders. DR Horton, Lennar, and some of the others that I've been watching are definitely on my radar, but I think DR Horton is the biggest one that I'm tracking to try to find a good position. I will drop some buy levels that I'm looking at for DR Horton before I jump in and load up the boat, if you will, looking for that turnaround and for people to start jumping back in on real estate. I'm also a big fan of financials, aka banks, but it's super interesting with this one, right? Because they've been making a lot of money in a high interest rate environment, because it's like, great, we'll charge you a ton of interest and then we'll just go on and repackage that into bonds or whatever other securities to sell off to other investors at a higher rate that we're giving you, and we'll pocket the difference. That's fantastic. But as demand goes up and people start actually taking out these loans for both commercial and residential, well, you're going to start to see actual revenue go up. I just don't know if that's going to be able to be turned into profits. Because remember what I said, banks take your money, charge you a rate, and then sell it to somebody else at a higher rate and pocket the difference. Well, those margins are going to get squeezed if that interest rate actually drops lower. So I'm just keeping an eye on things like your Wells Fargo and Bank of America, who are currently kind of undervalued right now, to see what they actually do. But I always have an eye on financials, because banks and financials run the world. Take, for instance, right now, when a lot of people are like using debt to finance basic stuff like food and groceries, Visa, MasterCard, Amex, and those companies have returned some amazingly strong profits right now. And let's see if that shifts when money starts flowing a little bit more through the economy. Well, like I said, these cuts are going to be like incremental. Like I said, we're looking at 0.25% coming up in September if it does come, and then they're going to have to slowly tease those out because they don't want to overheat the economy and push inflation right back up again. So as Jerome Powell loves saying, they're going to take a data-driven approach to this whole thing, but financials is something to keep an eye on. But also, we can't forget about the consumer discretionary stocks, aka the stuff we buy when we have extra money. Things like your retail, automotive, and like leisure companies are going to be great if you're looking to diversify. ETFs like XLY, which is another ETF that focuses directly on consumer discretionary companies, allows you to just invest in a basket of those companies, and you can track them to see what stocks they're putting into things, to see where you should be paying attention. But it's just super simple. The market is all about psychology and how the consumer is feeling. Like with this little correction that we had, we've seen the VIX shoot all the way up to 65. Now it's back way down in the teens, right? So that volatility is just driven by that fear and greed in the marketplace by people. So we all know this. You feel it in your pocketbook. Like, you're not spending as much money on that discretionary or disposable income stuff. Like, you're tightening up because money's hard to come by and everything's expensive as hell, right? But as interest rates start to come down, money starts to flow a little bit more, you might start to see people being more liable to finance these cars and other big purchases, and you'll start to see those companies push back up again as interest rates lower. And I mentioned tech stocks before. In the past, I've done well before, like AI, and it caused things to go out of control. And looking at undervalued growth tech companies that were investing a lot into research and development that weren't profitable yet, but had a great operating model and management and great plans for profitability beforehand. I think it's a little bit harder now to kind of look at that because most tech companies are investing in AI and they're a bit overinflated already. So what I've actually done is just take a step back and look at the price to earnings and ratio and some of the other financials of companies to try to find things that are trading below their actual value as a growth stock. And I'll be honest, like, it's harder to find in tech. That's why I am in some of the Vanguard tech funds and looking at the QQQ for broader tech exposure, because it's harder to pick out those undervalued tech companies. I think I covered some of my in a past video that have made some moves. You'll find those growth companies. I think Palantir was one I covered that I actually had some buy limit orders on that got triggered, and now they shot back up and I'm in profit on that. But I'll continue to do videos where I show buy levels of companies I'm looking for. But those are the sectors that I'm looking at when a sector rotation occurs as those interest rates drop. Remember, by the time something makes it to the news as an investor, you're probably already too late to get in. And I don't want you guys watching videos in a few months saying, oh, dadgummit, I should have invested in the real estate investment trust, or I should have invested in banks or some growth tech because I wasn't paying attention, and now it's already ran away from me in valuation. But if you dug this video, check out this one above because it is a banger as well. And like always, the aim of these videos is for you to leave more behind for your family when you die than just debt. Until next time, it's your boy Michael T. Ragland. I am out. Peace.